Wells Fargo wields the knife. We take a look at what hedge funds have been buying, and Wilt Chamberlain, well, he's really tall. You're in the right place, folks, because this is where the money is. Start off with the headlines, David, right over to the Wall Street Journal. We've got an article that says, headline is Wells Fargo cuts jobs in its mortgage unit. And the simple bottom line there is 2,300 employees are being let go in Wells Fargo's mortgage unit. It seems to me that this is probably a good move, that is almost definitely a good move. As interest rates have come up, the mortgage business is getting tougher. We're not going to see as many refinancing transactions. Great move by Wells Fargo, right?
Yeah, it's almost they had to do the move when the volume isn't there and the demand for the mortgage just isn't what it was last year for refinances. You have to scale back. You can't just have loan officers sitting there doing nothing. So it shows you that the mortgage business, there's this big concern that revenue is going to fall off a cliff. It's going to be terrible for the banks. That's true to some extent, but this also shows that the banks do have some levers that they can pull to offset some of those revenues that they're going to lose by taking out costs. And if we just think about Wells Fargo and the mortgage space, if we look at historically, and we have a graph here of how much mortgage banking has attributed to their just overall revenue. I see the past couple years after the recession with interest rates so low, they've really jumped out to the front of the pack, leading the market there when a lot of other mortgage lenders had to leave the market or had to scale back. But if we look back to the first half of the decade here, the first half of the millennium, it hovered in that 8-9% range, and it's been up of 18% in 2009 and almost 15% in 2012. So if we just think about historically, what are the norms, what are the levels of how much mortgage is going to attribute to Wells Fargo's top line? The normal level is lower than where it's been, so I think we're probably just going to naturally make its way back down to that 8-9% level.
If I were to sum it all up, people are very concerned about the top line impact of the reduction in mortgage origination fees, but at the end of the day, as investors, we care about the bottom line. If you can take out costs as the revenues fall, if you have that flexibility, you can salvage the bottom line. Sticking over with the Wall Street Journal, second headline, the 50 stocks most loved by hedge fund managers. We've got great representation here among the financial, from the financial industry. The top 5 overall, these are hedge fund holdings: Google, Apple, AIG, Citigroup, and GM. The top 5 financial holdings, and these are all very high up on the list. AIG and Citigroup, which we just heard on the overall top 5. Then JP Morgan, Bank of America, and Visa. I think the clear conclusion here is that hedge fund managers have been watching this show and have been hearing how positive we are about banks and financial companies, and they are buying. David, how can I be wrong on that?
Seems to. It's hard to argue. I know that's my personal opinion that I think all of those companies mentioned there. It's hard to argue that they're bad buys over the past year, and obviously they've done well, most of them.
Well, we can say definitively that
they have done well over the past year. But even going forward, it would be hard for me to argue that any of those stocks there are very overvalued. The price isn't realistic in terms of what it can get to in 5-10 years. So look at all those businesses, all those franchises. Looks like a pretty good group.
Surprising to me, the most surprising to me maybe was that when you look at the 3 of the 4 big bank stocks that made it into the top of this list, again, Citigroup, JP Morgan, Bank of America. Bank of America was a big favorite previously, and now you've got Citigroup and JP Morgan both ahead of it. JP Morgan, I've done a lot of talking about it lately. We've been doing a lot of talking about it lately. I think it's a great business. Given that it's producing results right now versus Bank of America, where it's more of a promise that those results will come, I support that. Citigroup's interesting. Before both JP Morgan and Bank of America, it's cheaper. The price, the valuation is cheaper, so there's that. And there is also, the story is starting to coalesce there in terms of the broad global story at Citigroup. And when we look at capital levels, which investors should be concerned about from a risk perspective, capital levels at Citigroup are pretty impressive. So maybe it's, I don't know, maybe these hedge fund managers are onto something, putting Citigroup so high up there.
Yeah, I mean, you have to give Citigroup a round of applause here. They've come in and done what they said they were going to do. With Michael Corbett coming in as CEO, he said, we're going to focus on winding down Citi Holdings, which was their kind of their bad bank off to the side there with all that toxic stuff. And they've slowly done that. They've built up capital ratios. And now Corbett said, our long-term goal is to have a return on assets of 1%, double-digit returns on equity. And when you have a bank trading well below book value and right at tangible book value, he's achieved the goals that he said he was going to achieve. If he can achieve those goals, it's a good long-term holding there.
Talking the talk and walking the walk, go figure. The third headline, final headline, comes from the Washington Post on your favorite subject, David. Fed debated ways to prolong easy money policies. The Federal Reserve minutes came out yesterday, and there was a lot of talk about whether and how to end the monetary accommodation. Your thoughts? I know you think that this drives your investing philosophy, right?
This
is all you look at.
It does not drive it at all. Definitely don't want to look at this and say, oh, the Fed's easing, I need to put all my money in stocks. I'm still looking at the companies. We talked about Wells Fargo just a minute ago. Think about a company like Wells Fargo. When interest rates went to rock bottom levels, they were able to scale up that mortgage lending, and they took advantage of low interest rates. I think you have to look at companies that are going to be able to do that on both sides. When interest rates are higher, is Wells Fargo going to be able to go out and make loans and take advantage of higher interest rates? So I'm still looking at this at a company level, not necessarily a Fed's easing. That means the S&P is going up 20% or going down 20% if they're not easing. Not really too concerned about it. I'm still looking at the companies.
I think there's a little bit of misunderstanding in that I think that there is opportunity for a lot of financial companies. If interest rates go back up, certainly for the banks, they can capture higher interest rates, and they can potentially have those lending spreads widen back out. On the insurance side as well, those insurance portfolios are largely invested in fixed income. Right now, they're forced to invest at very, very low rates. Short-term pain as the rates go up. I think longer-term benefit. My concern here is that the Fed ends up spending too much time watching the markets and the market's reaction and not enough time trusting the economic data. I think that the economic recovery could sneak up on us, and all of a sudden things are better, and all of a sudden the economy is pushing at its limits, and that's when you start to see inflation ramp up, and we don't want that. And so the Fed has to keep in mind, here I am counseling the Fed, keep in mind both sides of the coin, both that inflation and the full employment. I have a feeling that they are doing that, but I hate to see, and this is probably just media coverage, but I hate to see the relationship touted over and over again between the Fed watching the markets and how the Fed's impacting markets, because that shouldn't really be part of the picture. Right. Last week, David, we did our fantasy stock draft, our inaugural Motley Fool Financials fantasy stock draft. Earlier this week, we reviewed our number one picks. And today, let's go down and look at the number two picks, why we're excited, what we're concerned about, whether they actually were good picks.
Right, so there were four of us in the league there, and they're the rosters. So we each had 5 picks each, so there's 20 total there. And I had the, 6th pick overall there. And I grabbed insurer Markel, or specialty insurer Markel. So Markel doesn't go out and insure cars. They're not a Geico or a Progressive type insurer. They're a specialty insurer. So they're insuring things that you don't normally think about needing insurance: yoga studios, summer camps. So they're very specialized in what they do, and they're very good at pricing that risk over time. And the other day, we were talking to an analyst here that focuses on insurance stocks, and we asked him, what are the 3 things that you look for in a good insurer? And he said, good management, good history of profitable underwriting, and valuation. So when I look at Markel, they easily check off each 3 of these bullets here. We look at management, CEO Alan Kirshner, great CEO there, as well as the chief investment officer, Tom Gaynor, who's investing that money, has a great track record of successfully doing that. Underwriting profitably, they've done that over the long haul. And we look at valuation, it looks very cheap, trading just over 1x book value when you account for that recent acquisition they made with Altera back in 2012. So I look at all of those factors, and it seems hard to go wrong with Markel as my second pick. But I don't know if you disagree.
No, I don't disagree, and should have been a second pick. It's
questioning the value.
It's such a great company. I own it myself. I own it in my real money portfolio at the Fool, and I admire the management. I admire the company. it could have ended up my second pick. I was right after you. The question is, should I have gone for it as a first pick? I don't know. It's the valuation maybe is just slightly too high when you look at it on a tangible book value basis to make it that the first pick. Maybe it's right there and right to be a second pick. But it's hard to, like you said, it's hard to argue with that as a second round pick. Just such a great company. And one thing that I will mention is you said they don't insure cars. Actually, they do insure cars, but not standard auto insurance policies. They do look classic cars, so it goes with the specialty insurance. I'm Josh,
giving me a hard time
here. But yeah, they insure specialty cars, so collector's cars, high value cars. I guess the kind of cars that Jay Leno would have in his collection.
Right.
So looking at my second round pick, I went with Capital One. Capital One, of course, most people know as the credit card bank, and credit card operations still power this company. I think in the second quarter, about 65% of revenue came from the credit card business, and they made a big acquisition recently to increase and bolster the credit card business. But I think the big move over the past few years was the acquisition of the ING Direct business, now the Capital One 360, which is an online bank. This gives them a much bigger footprint in consumer banking, in sort of standard banking operations, and a much higher deposit base, which gives them a low funding cost for the entire operation. So when I look at Capital One, I think in terms of opportunities, I think the credit card business is still a huge opportunity. It hasn't performed. There were a lot of expectations, I think, that credit cards were going to take a big hit during the financial crisis and in the aftermath. To some extent they did, but nowhere near, I think, what people thought would happen. It was a housing bubble.
Right.
And what ended up happening is we saw a lot of turmoil, a lot of pain in the housing market, but it didn't flow through as much as people thought to credit cards. People continued, by and large, to pay their credit cards, even if they stopped paying their mortgage. And so I think the credit card business is still a very good one. You get very nice spreads there. Of course, the defaults are higher than other types of loans. But if you look at the types of rates that banks have to take on mortgages right now, on the securities they're investing in, it's almost a no-brainer to have this credit card business. And Capital One has been doing some expanding, while we look at JP Morgan and Bank of America, I think, which actually have been tailing off a little bit. As a shareholder of both of those, I'd love to see them get a little bit more aggressive on the credit card side. Number two opportunity over there at Capital One, this broader bank operation. One thing about Capital One, having been more of a credit card business and now becoming a broader bank, I think it gives it opportunity that it wasn't tinged as much from the financial crisis as some of the other bigger banks. And it is a big bank. So it gives it opportunity to compete with Bank of America, to compete with JP Morgan and Citigroup, and not have as much of that stigma hanging around from the financial crisis. Now, as we've discussed before, in terms of people leaving Bank of America because of that tinge, because of the headline risk, that doesn't really happen, I think, as much as people think it does. But at the same time, I think there is some opportunity there. And finally, just a general banking sector rebound. We were just talking about the Federal Reserve and interest rates. As interest rates come back, I think, again, some short-term pain for banks on the balance sheet, but longer-term higher rates will be better. There are some threats as well. Credit card competition, like I can't be the only one looking at the credit card business and saying this is a great place to be. So if others move in, Capital One, though, great operator in that business. So I would think, and I would like to think, that they will be able to outperform others because they're a more focused and better operator in the credit card business.
Yeah, I thought it was a great pick in the second round too. I was eyeing it for my further rounds down there. They made an acquisition just last week of a company called Beach Street Capital. Not many people have probably heard of it. It was a private commercial real estate multifamily lender, which is kind of a side of the market that we don't talk about too much, especially being a private company. It wasn't a huge acquisition for them. They didn't even have to disclose the cost. That's how immaterial it was, I guess. But they're moving just further into that commercial lending space, whether it be commercial real estate in this case, or just commercial business lending in general. And when we talk about the commercial real estate business, that's an area that's really dominated by JP Morgan, as you mentioned, Wells Fargo. So Capital One, they're this smaller, not small, but a smaller fringe player that's making these acquisitions to move in and fight JP Morgan and Wells Fargo head on for some of these commercial real estate loans. So I like what I'm seeing out of Capital One, and it'll be an interesting story to watch over the next couple of years.
It'll be interesting for my portfolio as it outperforms greatly. If you look at the valuation, it doesn't look silly cheap like maybe some of the other banking stocks. But if you look at the returns that Capital One earns on its equity, it's more than earning its keep for that valuation. Moving on to a new segment that we have here called Bold Statements. In investing, it's not a black and white world, but and so there's always nuance. There's always probabilities that can go for or against you. But sometimes you just have to step out there and make a bold statement. And let's get started, David, with one of your bold statements. What do you got for us?
I'll go a little short term in nature here. First bold statement is 30-year mortgage rates will be below 4% at some point at the end of the year. So we've seen them spike up to almost 5, not 5 quite yet, but above 4.5% recently. I think it may be a little bit of an overreaction, a little looking too far ahead. I could definitely see the Fed not ramping up purchases, but staying committed to those purchases to drive mortgage rates down, because that's really the reason behind a lot of this quantitative easing, is to get people to buy homes, then you fill those homes with consumer goods, et cetera. It really spurs the consumer spending. The rising mortgage rates have been a concern for the banks like Wells Fargo, we talked about earlier in the show. Not as much refinance activity. Home first purchase activity hasn't slowed that much, but there's concerns that if mortgage rates stay high, it will price some people out of the market. My bold statement is it's going back below 4, and we'll see a little bit of a bump back up there.
That is bold. I also think it will be wrong.
Well, it's one you wanted bold.
But that is bold, and I like you getting out there on the boldness. My first bold statement, and to me, I just think I think this is obvious, but the 4 largest banks, Wells Fargo, Bank of America, JP Morgan, Citigroup, as a group will outperform the S&P over the next 5 years. Bold statement. But to me, it's a gimme. You look at the valuations, you look at the directionality of the industry, and I think they're primed to continue outperforming. If you look at the performance over the past few years, it's been stellar, and I think there may be a lot of people looking at that and thinking that's not replicable. But the key is that the financial sector, the big banks, a lot of banks were just beaten down so far that there's a lot of room for recovery. Wells Fargo valued higher than the other banks, higher quality operation. Could be a little bit of a drag on that, but I think the other 3 will more than make up for that.
Yeah, I think that's interesting. You say these stocks have had a great run the last year or so. Look at Bank of America, Citigroup. But even if Bank of America gets back to half of where it was pre-crisis, $25, that's almost double from where it is now, almost. So it just shows you how much dilution there was in these shares, and it's not going to be an overnight thing. We were talking to one of our writers, John Maxfield, who covers Bank of America a fair amount, and he was saying this isn't going to be a 1-year transformation. It's going to take multi-years in order to get that dilution back and return that capital to shareholders. And like you said, over the next 5 years, it'll outperform the S&P. I would tend to agree with you on that. I would agree with you. I'm not going to tend. I'm agreeing.
All right. Get bold again, David. What's your number 2 bold statement?
Last bold statement is we are going to, at some point in the next, let's call it 3 years, see a flurry of bank mergers and acquisitions. The past couple years, it's been very quiet out there. Not much going on. A couple small players merging, some specialty lenders merging with traditional banks, some strategic mergers are going on out there. But largely, we have not seen mergers with the bigger banks out there. I'm not saying Bank of America is going to buy more. I'm sure you're happy with that as a Bank of America shareholder. I don't see JP Morgan making an acquisition because they have that Fed oversight. I don't think there's appetite for these banks to get bigger. But I'm looking at banks like KeyCorp, Huntington Bank shares. Those banks that are those super regionals, maybe even below super regionals out there, scale's the name of the game in banking. That's what it's been over the last 100 years. You have to consolidate in order to compete with some of the bigger players to have that breadth of services there. Right now, it doesn't make a lot of sense. Deposits aren't super coveted because interest rates are so low. They can't take those deposits in and then lend them out at very high rates. But if we do see rates over the next 3 years bump back up, I think it makes a lot of sense for a bank like KeyCorp, Huntington Bank Shares, to explore some of those acquisition or merger opportunities out there.
Okay. That is
quite
bold. That's pretty bold. That's pretty bold, given that there was the expectation of a whole lot of merger and acquisition activity in the banking sector post-crisis, and there has been some. There hasn't been a whole lot.
Right.
Now, I had one here, but I had an idea as you're talking. So here's my next bold statement. Within the next 3 years, there will be a major catastrophe that leads to big insurance industry payouts that shakes up the industry. Now, let me be clear. I am not hoping for a catastrophe. It's terrible. I mean, you have probably loss of life, damage to property, everything like that. But when we think about just probabilities, and when we think about the insurance industry, this is what happens: is that you have periods where there's not really much to pay out on, and then there are periods where there's a big catastrophe that, a Katrina type thing. So these are really tough to predict, but we're getting bold here. So I'm going to say within the next 3 years, and that'll be very bad news for certain insurers that are not prepared for that. And I think this will be particularly on the property casualty side, and then on into the reinsurers. But when we think about the best run insurers, you were talking about Markel earlier in the show, and I'd like to think that AIG is getting there. I would also put Travelers in this. Travelers, I think, is a very well-run insurer, much more so than AIG is currently. So I'd have much more faith in Travelers being able to. But and Berkshire Hathaway. What am I thinking? Why did I mention Berkshire Hathaway? Great insurance operations. They have a big catastrophe unit that insures against catastrophes. But anyway, when a big catastrophe hits, it requires a lot of payouts throughout the insurance industry. That can send some insurers out of business. It can cripple a lot of insurers, but that allows the stronger insurers to survive, to get better rates going forward. This will be particularly interesting within the reinsurance industry, where there's been a lot of capital flowing into the reinsurance industries, particularly from pension funds, from hedge funds, and so prices have been softening in that market, and something like that could harden up prices. So again,
it's bold.
In no way would I want to see a catastrophe, but just thinking probabilistically and thinking about the insurance industry, next 3 years, I think maybe we'll see something. I think we will see something. We got to be bold here, and that would be good news for some of the better run insurers. So finishing off as we always do on Twitter, David, take us out with Tweet It.
So the first tweet we're looking at, we're going to go to some consumer good retailers here from Modest Proposal, who is at Modest Proposal 1. Gun to the head, own JCPenney or Sears for the next 18 months. So I'm not going to necessarily put you on the spot for this unless you want to answer that question.
You like putting me on the spot.
But it got me thinking.
You like to see me make a fool of
myself.
Sweat
a little bit. But it got me thinking, you can answer this, and also, is there a financial stock out there, a bank, an insurance company, a REIT, that you just look at and you say, I don't want to own that. If I put that in my portfolio, I'm not comfortable having it in there for the next 2 years or so.
When you mentioned this to me earlier, I had a non-specific answer in mind, and so I'll start with that non-specific answer, but I do have a particular answer as well. The non-specific answer is that the financial company that I would not feel comfortable holding is the one that I don't understand, that I haven't studied up on, that I haven't learned about. And I think, in particular for investors who have been watching the stock market success of a lot of financial companies, you start to get the psychology, the greed, the juices flowing. I got to get in on these. Got to get in on these banks. Got to get in on some of these other companies. And you jump in without really doing the work that needs to be done beforehand. So any company, any bank that I haven't done that work on, that I don't understand, I would feel uncomfortable having in my portfolio. The specific answer: Fannie Mae and Freddie Mac.
Fair enough.
The political risk there, the risk that they will be wound down, and that common shareholders, I'm thinking particularly about the common shareholders will get zilch, makes me not want to have them in my portfolio. How about you?
I'm not touching them either. I'm going to steal your answer too. I think that's the best answer you can get in terms of putting them in your portfolio, not looking at it for 2 years, and opening it back up and seeing what's going on in there. Those are the two stocks, I guess you can call them stocks, the common shares that are over the counter, that I just would not be comfortable. I could not sleep at night knowing that I had a lot of money in those and I could open it up and it's zero. The next one we got is about credit cards. You were just talking about him earlier, from Quentin Fortrell, and his Twitter handle is @Guantanamo. And he says, the hidden cost of credit card rewards. Guess what bank is 100% transparent on rewards programs? And he links out to a MarketWatch article there. Do you know?
Can I guess?
Yeah.
100% transparent on credit card rewards. Can I go Capital One?
That is correct.
Yes.
100%.
Boom.
Transparent on their rewards program.
Another notch in Capital One's belt.
Exactly. The surprising part of the list that was on the article there was number 2, Bank of America. Number 2,
No,
number 2, Bank of
be a
America,
lie.
and number 3, J.P. Morgan. 2 of the big banks that get ridiculed very often. So Capital One, Bank of America, and J.P. Morgan were given the highest marks for transparency in terms of how their rewards programs work. I thought that was pretty surprising.
I think that's very surprising. Well, yeah, it's surprising. It's surprising. People love to hate all those banks.
The last one we got, a little light here. You mentioned Wilt Chamberlain in the intro, and we have a tweet from Eric. Do you know Eric? Eric
Malinowski.
Malinowski. Let's call him Malinowski. @EricMall. Give me a sec. And he retweets from SI Vault. Wilt Chamberlain would have turned 77 today. Here he is in 4th grade. Can you spot him? And we have the picture that he links out to. Matt, can you spot Mr. Chamberlain?
I can indeed spot Wilt Chamberlain in that picture. And the reason that I wanted to include this, the reason that I loved this, was I was thinking back to a Warren Buffett. I'm not going to get the direct quote here, but Warren Buffett basically talking about finding good investments, finding good value, and in relating that to modeling. So if you model out a company, if you're trying to get an exact price, like here's how much a company is worth, his advice was, if you see a guy it was something along the lines, if you see a guy that's overweight, you don't need to know that he's exactly 400 pounds to be able to say that he's overweight. And this picture of Wilt Chamberlain, same kind of deal. It's very obvious. You look at the picture, you know, that's Wilt Chamberlain. And I think that really does work out when you do the work, when you're willing to look for values within the market. Sometimes it really is just that obvious to be able to find value out there.
Linking Wilt Chamberlain to financial modeling. I have no more to offer to that.
All right, for David Hansen here, I'm Matt Copenheffer. Thanks for watching.